With my latest video talking about how condos might be a good investment, more people are now coming to us asking what the key difference is between investing in a Toronto house versus a Toronto condo. So in this video, I'll try to answer this and talk about how returns might differ, how your risks might be different, and what is better for you depending on what type of investor you are. Before I start, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. The difference in returns is most likely your first consideration, so let's dive right into this. You make money from real estate in two main ways: rental income and appreciation. From the rental income side, condos make less than houses. What we typically look at is the net rent yield, which is calculated by deducting operating expenses from the rent you get before mortgage payments, which we call the cap rate, and the higher the cap rate, the better. On average, the cap rate for houses is around 1.5% higher than the cap rate for condos. Cap rates do fluctuate and usually move in line with interest rates. When interest rates rise, cap rates tend to go up, and when interest rates drop, cap rates also usually go down. Right now, with variable interest rates at around 1.5%, we're seeing a 2.5% cap rate on Toronto condos and closer to a 4% cap rate on a Toronto house. When variable rates were 1% higher than they are now, cap rates were also around 1% higher. Because of this, the net income you get is more or less the same even when interest rates change, with condos being around 1% and houses being around 2.5%. Now, I'll quickly explain why there is a difference between cap rates for condos versus houses. The first big reason is barrier to entry. Investors tend to drop out as the purchase price increases, so you tend to get a better bang for your buck if you go bigger. The second reason is time savings. Condos tend to be newer and there's generally less management because the condo management takes care of a lot of things in exchange for condo fees. So some investors choose condos because of this reason and are willing to exchange the management ease with a hit on rental income. Note that income is not the same as cash flows. Traditional mortgages require you to pay back a bit of your loan each month, which totals roughly 2% of your purchase price per year. Think of this as a piggy bank, and it's actually a gain for you, not an expense, but the cash does get tied up in your property. Because the net income on condos are lower, after you pay into the equity gain each month, you end up getting negative cash flows on the condo, whereas it's still slightly positive for houses. Appreciation trends are also a bit different between condos and houses. If you compare Toronto condos with Toronto detached houses between 2010 and 2020, you'll find that condos saw an 8% price growth each year, whereas houses saw a 10% price growth per year. So if we add up the net income plus appreciation, you'll see that condos get a total return of 9% and houses get 12.5% each year before leverage. From what I just talked about, the more stable part of a real estate investment is the rental income, whereas appreciation can swing a lot more, and it's possible to see a plus or minus 8% swing from the average appreciation in any given year. In fact, that's exactly what's happened over the past 2 years, and Toronto houses have been on the higher end of their appreciation range, whereas condos have been on their lower end. Ultimately, appreciation is the big reason houses have been performing much better. And when you think about it, that 1.5% difference in rental income isn't actually big enough to make a drastic difference. Now, some people feel that the pendulum for appreciation might swing the other way as we recover from COVID. So if appreciation gets swapped and condos start appreciating 7% more than houses for the next 2 years, then condos will see better returns for the first handful of years. But remember, if we look at history, houses do have better long-term appreciation and rental income. So if things bounce back to how they were like starting year 3, then you'll see houses start to catch up, and the break-even point is actually around 5 years. After the 5-year mark, Houses, which have the better average annual returns, will ultimately be the better long-term investment. The important thing to understand here is that you do have the potential to make more money on a condo in the short term, but returns are highly dependent on where appreciation lands. So with a higher weight on appreciation with bigger swings, I'd say investing in a condo is higher risk and investing in a house is more balanced because rental income is a bigger part of your returns pie. While we're on the topic of risk, I'd also touch on value add opportunities. In my opinion, I think taking on renovations to boost your returns is a more reliable way to bump up your property value. So in a way, you're reducing your investment risk when you take on renovations. Note that there tends to be more value add opportunities for houses, so it's possible for you to further reduce your financial risk when you invest in a house that needs value add work. The last type of risk that I do get asked more frequently is tenant risk. Yes, the tenant profile is different for condos versus houses in Toronto, but I wouldn't say that one is more risky than the other. I think the more important thing to do is to do your due diligence to make sure you're putting in good tenants that pay rent on time and will take care of your property. And that's really not based on the type of job the tenant does. The bigger difference here might be on how long the tenant stays. Typically, condo tenants turn over more, which lets you track market rents more closely. If you're renting a house to a family, they tend to stay longer, so you might end up seeing your cap rate start to drop until your tenant turns over. Now, if you're thinking about investing in real estate this year, what should you invest in? Well, if you ask me, I definitely think that the best risk-adjusted returns are always in houses. So if that's the case, who is actually right for investing in a condo? I think the first most important thing when you invest in real estate is to make sure you can hang on to it. Condos give you negative cash flows, so you need to make sure you can put in an extra $300 to $500 into the condo to support the investment each month. Note that if we assume rents go up by 5% per year, it'll take you approximately 5 years before rents grow enough for your cash flows to start turning positive. Real estate is a good way to build wealth, and even though houses can generate better returns, condos are still a good investment if you don't have enough money to buy a house. If we look back at the difference in total returns, you can see that we're looking at 2% lower annual appreciation and 1.5% lower cap rates in a condo versus a house. But based on average numbers from 2010 to 2020, that's still a 9.1% return for condos before leverage and almost a 40% ROI, assuming that you put in 20% as down payment. So investing in a condo is still a very good idea. The third big reason why I'd say condos are a good idea is if you're looking to diversify your investments. As we've been seeing, condos and houses can move in different directions, so if you have both in your portfolio, then it is more likely that you'll see your overall portfolio have more stable appreciation. Or you might also want exposure to a certain higher growth area, which means it might outperform drastically, but perhaps that area is higher risk. If that's the case, buying a condo in that area is less money, so you can limit your exposure in those markets. The fourth reason for investing in a condo is if you want a more hands-off experience. Like I mentioned, condos are newer, so you're basically taking a hit on your rental income in exchange for a more passive investment. If you're still confused and you don't know what's right for you, our team is here to help. What we can do is look at your situation to find out what's really best for you and then make it happen by helping you buy that perfect investment property. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.